Intro. First, welcome to this global economic outlook for the year 2026. This report combines up-to-date data from late 2025 with structural insights up to mid-2024. The goal is to give you an honest and balanced picture of where the world economy may be heading, whether the outlook is positive, neutral, or negative. Section 1. Executive Summary. First, the base case scenario. The most likely outcome for 2026 is a neutral one, moderate global growth with easing inflation. The probability of this scenario is about 55%. Second, the downside scenario. A sharper slowdown or mild global recession could occur if key risks materialize. The likelihood is roughly 30%. Third, the upside scenario. A stronger than expected recovery remains possible but less probable, around 15%. Section 2. Current situation. Now let's look at where things stand right now. First, global growth. According to the latest International Monetary Fund and Organization for Economic Cooperation and Development projections, global growth is expected to moderate in 2025 and 2026 to around 3,1 to 3,3%. That means steady but unspectacular expansion. Second, inflation. In most advanced economies, headline inflation continues to ease, while core inflation declines more gradually. This suggests that central banks will approach rate cuts cautiously. Third, monetary policy. Markets expect some rate reductions in late 2025 and throughout 2026. However, policymakers are still balancing the risks between cutting too early and cutting too late. Fourth, China. The Chinese economy faces structural challenges from real estate weakness to demographics, but remains committed to targeted stimulus measures. Its growth trajectory will significantly influence global demand. Fifth, commodities. Energy agencies expect subdued oil demand and potential oversupply into 2026. That could help keep global inflation lower, but may hurt energy exporting countries. Section 3. Outlook for 2026. Now let's explore each of the three possible scenarios in more detail. First, the neutral or base case scenario. In this path, the world economy grows moderately at about 3%, while inflation continues to drift down towards central bank targets of around 2 to 3%. Monetary easing proceeds gradually. China maintains stability through modest stimulus, and commodity prices remain contained. This outcome is consistent with most institutional forecasts and represents a balanced, middle-of-the-road projection. Second, the negative or downside scenario. This involves a mild global recession or sharper slowdown. It could be triggered by escalating trade tensions, a deeper Chinese slowdown, or another major geopolitical or financial shock. In this case, growth turns negative in some advanced economies by late 2026. The odds of this outcome are about 30%. The consequences would include higher unemployment, corporate stress, and falling risk asset prices. Third, the positive or upside scenario. Here, faster disinflation allows central banks to cut rates earlier and more decisively. China launches a larger fiscal stimulus, and global demand rebounds strongly. Growth could surprise to the upside, although the probability is lower, roughly 15%. For this to happen, several favorable developments must align simultaneously. Section 4. Key indicators to watch. First, inflation readings such as consumer price indexes and core inflation data. If these numbers stall above targets, central banks will delay rate cuts. Second, central bank communications, particularly from the Federal Reserve, the European Central Bank, and the Bank of England. Their tone will signal how quickly policy might shift. Third, data from China, including gross domestic product, property sector indicators, and any new stimulus announcements. These are critical for global trade expectations. Fourth, geopolitical events or trade disruptions, such as tariff announcements or new conflicts. These can instantly change the market outlook. Fifth, credit conditions and leverage levels in financial markets. High leverage increases the risk of sudden market corrections. Section 5. Practical implications. For policymakers, the challenge is to balance cautious rate cuts with vigilance against inflation returning. Targeted fiscal support should be preferred over broad stimulus. For investors, diversification is essential. In a neutral or negative environment, quality assets such as strong corporate bonds and short-term debt tend to hold up better. For households, managing debt exposure is key. Locking in fixed rates and maintaining 3 to 6 months of savings can provide a safety cushion in case of slower growth. Section 6. Comparison with 2024 baseline. At the time of mid-2024, forecasts were more optimistic. Since then, updated reports from 2025 show slower growth and easing inflation, reflecting tighter monetary policy and reduced global liquidity. Structural issues in China, ongoing geopolitical tensions, and trade policy uncertainty have added further weight to global risks. Section 7. Conclusion. To conclude, the outlook for 2026 can be summarized as follows. Neutral or moderate growth, with easing inflation, most likely at 55%. Negative or mild global recession, possible at 30%. Positive or stronger rebound, less likely, around 15%. In simple terms, the world economy is expected to move forward, but cautiously. Inflation should continue to decline, but risks remain, particularly from trade frictions and China's slowdown. Overall, the story of 2026 is one of slow but steady progress, with vigilance and adaptability as the keys to resilience.